Hey everyone, and welcome back to the Deep Dive. Today we're plunging into the second quarter 2025 earnings call for Entegris. They're, a really vital player in the semiconductor space, making the super pure materials essential for chips. And the big question today, the real head scratcher, is this. How did a company that actually beat estimates, both on revenue and earnings, still end up with its stock taking a pretty significant hit after the announcement?
Yeah, definitely raised some eyebrows.
It did. So we're going to try and piece that puzzle together. We'll dissect the numbers, look at their strategy, and unpack the industry dynamics really at play here. Okay, let's jump right into those headline numbers. Q2 2025. Because, on the surface, they looked okay, right?
They did. Non-GAAP EPS came in at 7.26 cents.
Which was above a consensus, 7.64.
Right, and revenue hit $792.4 million.
Also beating the street's $766.8 million estimate. So, a clear beat top and bottom line. But, and this is probably the crux of it, that revenue figure, while beating estimates, was actually down 2.5% compared to last year.
Yeah, that year-over-year number matters.
It does. And then you look at margins. GAAP gross margin at 44.4%, adjusted EBITDA margin 27.3%.
Okay.
And then there's the debt. Net leverage is sitting around 4 times EBITDA.
Oof. Yeah. 4 times is certainly noticeable. Investors definitely watch that metric closely.
For sure. It signals, that deleveraging has got to be a major focus.
Absolutely.
So this whole paradox, beating the quarterly numbers, but the stock slides pre-market and closes down, it really tells you something, doesn't it?
It tells you that in this kind of market, near-term stuff like margin pressure and high debt,
right.
Well, they can easily overshadow a decent top-line beat, even if the long-term strategy looks sound.
Exactly. So to really get why the market reacted like that, we need to pull back the layers a bit. Let's start with the segments. What actually drove these numbers within their main businesses? What did you see in Materials Solutions, or MS? That one seemed okay.
Yeah, MS was definitely the stronger segment this quarter. Sales were up 4% year over year and also up 4% sequentially from Q1. So good momentum there.
Okay, what was behind that?
Well, it was mainly driven by strong demand for things like CMP slurries and pads. That's the mechanical planarization stuff, basically super precise polishing.
Right, critical for chip making.
Exactly. And also selective etch and deposition materials, foundational tech. And interestingly, they called out strong growth in China, which is, a key region, plus a positive boost from high bandwidth memory, HBM, ramps.
Ah, the AI connection.
That's it. HBM is crucial for AI chips. And they also mention early stages of node transitions in logic and 3D NAND, so the move to smaller, more advanced chips, which usually need more advanced materials.
So good drivers there. But what about the margins in MS?
Right. So despite the good sales, the adjusted operating margin for MS was 21.3%. Now, that was up year over year, which is positive,
Okay.
But it was actually down slightly sequentially. And management chalked that up to some operational inefficiencies. We should probably circle back to that.
Definitely. Okay, so MS looking pretty solid overall, driven by advanced tech. How did the other big segment, Advanced Purity Solutions, APS, compare? Was it the same story?
No, actually quite different. APS tells, a much tougher story this quarter. Sales there were down 7% year over year.
Wow, okay.
They did tick up just 1% sequentially, so maybe stabilizing a bit. But that year over year drop is significant.
What caused that?
It was mostly due to a slowdown they expected in facilities-based capital spending. So think of APS as providing the ultra-clean filters, the fluid handling systems for the fabs themselves.
The infrastructure.
Exactly. So when chip makers pause or slow down building new fabs or expanding existing ones, this segment feels it directly. It particularly hit their FOUPs revenue. Those are the super clean wafer carriers and their general fluid handling business.
Okay.
They saw some modest growth in liquid and gas filtration and photoresist, which helped a bit, but couldn't offset the bigger declines, lower volumes for the main.
The margins there
Also took a hit. Adjusted operating margin for APS came in at 24.1%, down both year over year and sequentially. Again, primarily because of those lower volumes.
So it really paints that picture of a mixed demand environment, doesn't it? Advanced materials are hot, but broader fab investment is, cooler.
Precisely. Very uneven.
Okay, so that mixed segment performance starts to explain some of the market's caution. But let's pivot to something potentially more impactful long-term. Management gave a pretty detailed update on their global manufacturing and supply chain strategy. It sounds like more than just tweaking things.
Oh, it's way more than tweaking. This is where it gets really interesting strategically. They're making pretty substantial progress shifting production around. The goal is clearly to manage geopolitical risks, tariffs, all that stuff.
Right. So what's the plan?
The scale is ambitious. They expect to serve about 85% of the demand that's destined for China, but serve it from other Asian sites by the end of this year.
85% by year end, from places like Taiwan, Japan, Korea, Malaysia.
Exactly. And they're aiming for 95% sometime next year. That's a massive shift, a real re-architecting of how they supply that market.
Wow, that is aggressive. And it's not just moving things around in Asia, right? They're building capacity elsewhere too.
Absolutely. Look at the new Colorado facility for CMP pads. That's backed by CHIPS Act money.
Ah, the U.S. investment.
Right. Construction, tool installation, mostly done. Grand opening planned for November. And they expect customer qualifications to start later this year. That's crucial for onshoring supply for U.S. customers.
Makes sense. Any other moves?
Yeah. They also just opened a new state-of-the-art technology center in Korea.
Ah, closer to the memory giants.
Precisely. Localizing R&D, strengthening ties with the big DRAM and NAND players right there. It puts their innovation right where the action is for advanced memory.
So putting it all together, this huge localization push is about shorter lead times, less working capital tied up, more secure supply, especially now with trade being so volatile.
That's the end game. More resilient, more efficient, closer to the customer, less exposed to geopolitical friction. It looks very strategic for the long run.
It does. But, I mean, doing all this at once, shifting production, building new plants, that sounds expensive and disruptive in the short term, right?
You nailed it.
Because despite these long-term upsides, those Q2 gross margins were definitely squeezed. What's the connection there?
Yeah, management was upfront about the margin compression in Q2. They pointed to a few things. First, the direct hit from tariffs, that's just cost.
Right. Okay.
Second, they made, strategic choices to balance production volumes with inventory. Basically, keeping supply flowing, even if it meant running lines maybe less efficiently for a bit.
Prioritizing customers over immediate cost, maybe.
Could be. And third, and this is key, those operational inefficiencies we mentioned earlier, they directly linked them to accelerating these supply chain shifts, ramping up new facilities in Taiwan and Colorado. That always comes with startup costs and a learning curve.
Right. You don't just flip a switch on a new fab line.
Exactly. So they're taking some pain now for the hoped-for gain later.
Okay. That makes sense strategically, even if it hurts the P&L short term. So to counter that, they launched that cost-cutting program, right? $50 million annualized.
They did. Kicked off in Q2. It definitely signals they're trying to get a handle on the costs associated with all these changes, tighten the belt a bit.
But are they still confident about the long-term margin picture, despite this Q2 pressure?
They seemed quite firm on that. They reiterated that the long-term path to higher gross margins is still intact. They expect improvement as volumes pick up, assuming the semi-market recovers. And crucially, as these new facilities fully ramp up and get optimized.
So once the inefficiencies are ironed out and they're running at scale,
the cost benefits of localization should start to properly kick in and help margins expand again. That's the plan anyway.
Got it. Okay, let's talk financial health then, especially with that debt load post-CMC acquisition. How did free cash flow look in the first half?
So free cash flow for the first 6 months was $79 million. They are generating cash. Their target for the full year 2025 is a free cash flow margin in the low double digits, which is decent, but, it's below where they used to be.
Right. What's the longer-term goal?
The ambition, and what investors are really watching, is getting back to the mid to high teens FCF margin, back to pre-pandemic levels. That would signal a real recovery in cash generation.
And what about paying down that debt? You mentioned the 4x leverage.
Yeah, critical point. They paid down $50 million of their term loan just after Q2 ended, which is good, a step in the right direction.
So net debt is around $3.7 billion now.
Roughly, yeah. And leverage still around that 4x EBIT mark. Management couldn't have been clearer. Paying down debt is the single priority.
What's the target leverage?
They want to get gross leverage below 4 times soon, and the longer-term goal is even more aggressive. Get net debt below 3 times EBITDA by mid-2027.
Okay, so a clear path laid out for deleveraging. That's going to be absolutely key for market confidence, I imagine.
No doubt, especially after a big deal like CMC. Execution on that debt paydown is crucial.
Definitely. Okay, so they're juggling these big strategic moves and near-term financial pressures. What about the wider industry? What's Entegris seeing in terms of trends in the outlook? Still seems pretty mixed out there.
Very mixed is the right word. And this is where you get some interesting nuance. AI is obviously the hot topic, right? Driving growth in advanced logic, HBM.
Yeah.
But management put some numbers on it. They highlighted that AI demand, even now, is still a pretty small slice of the overall pie, less than 5% of total wafer starts.
Less than 5%. Wow. That's important context for you listening. AI is exciting, but it's not yet driving the entire industry volume-wise.
Not by a long shot, apparently. And overall fab activity, especially for like mainstream logic chips and standard 3D NAND memory, that remains pretty subdued.
So the bread and butter stuff is still slow.
Yeah, they expect wafer starts for the full year to grow only very modestly, if at all, and industry capital spending flat at best.
So pockets of strength and high performance, but the broad base is still cautious, like you said, uneven.
Very much so. It's not a tide lifting all boats equally right now, more like specific currents.
Okay, so given that sort of lukewarm backdrop, what are they saying about the second half of this year? Any optimism?
They do expect a stronger second half compared to the first. A couple of reasons.
Okay.
One, they see inventories finally trending back towards more normal pre-pandemic levels. That suggests the destocking cycle might be nearing its end, which should help wafer starts sequentially.
That would be welcome news for the industry.
Definitely. And two, they anticipate those node transitions, the move to more advanced chip designs, starting to have a more positive impact in Q4, particularly for NAND memory and advanced logic.
So maybe some green shoots appearing later in the year from inventory normalization and tech transitions?
That seems to be the hope. Cautious optimism for the back half, driven by those specific factors, even if the overall market remains mixed.
Right. Okay, so we've unpacked the numbers, the big strategic shifts, the financials, the industry view. Let's try and tie it all together now. Connecting these dots, what does it really tell us about why the market reacted so negatively, and what's the bigger picture for Entegris as an investment?
Well, I think the market reaction really boils down to investors zeroing in on those near-term headwinds. Yes, they beat the Q2 numbers,
Right.
but that year-over-year revenue decline, the margin pressure we talked about from tariffs and inefficiencies and that elevated debt level, those just weighed more heavily on sentiment right now.
So the immediate challenges overshadowed the beat and the long-term story.
Exactly. And you see it in the stock's performance relative to the broader semiconductor index, the SOXX. Entegris has significantly underperformed over the last 12 months. It reflects that ongoing investor concern about tariffs, how quickly they can offset them, and crucially, how fast they can pay down that debt from the CMC deal. Deleveraging is absolutely paramount in investors' minds.
So you have this real split, don't you? Management is cautiously optimistic, talking up the second half, the long-term benefits of localization, positioning as this secular AI fabrication enabler.
Right, painting that strategic picture.
But investors, at least based on the stock reaction, are much more focused on the here and now, the operational speed bumps, the hit to margins, that debt load.
It's a classic disconnect, and it raises that key question for you listening. Can Entegris management convince the market that their long-term strategic vision, navigating the tariff issues, capturing growth from advanced materials, becoming that key AI enabler, is strong enough to look past these current hurdles?
That's $1 billion question, isn't it?
Pretty much. And there are specific things to watch that could help bridge that gap. Key catalysts coming up.
Like what?
Well, there's an analyst day in September that could be crucial for providing more detail, more clarity on things like CMP pad capacity and, importantly, the drivers for margin expansion.
Okay, more visibility there.
Then Q3 results in late October. That'll be the first real test since this call. How well are the tariff offsets actually working? Are those operational efficiencies starting to improve?
Real proof points needed.
Exactly. Also, keep an eye out for any more CHIPS Act funding news, maybe for their Taiwan filtration line they mentioned.
Right, and the leadership change.
Yeah, that too. Bertrand Law moving to executive chair, Dave Rear stepping up as CEO. The market will be watching closely for smooth execution and continuity during that transition.
Lots to track there. So bringing it home for the listener, considering this space, well, what does it all mean? All right, let's shift gears. Time for our This Is Not Financial Advice segment. Putting on our, let's say, creative thinking caps. Given everything we've just discussed about Entegris, what's an outrageous but maybe plausible trade idea?
Okay, not financial advice, disclaimer, firmly in place. But thinking about it, given that the stock's pulled back, roughly 30% year to date, and looking at the valuation, you could maybe consider a long-term value play. The idea would be to potentially build a position, perhaps averaging in on any further weakness.
Okay, what's the thesis there?
The thesis hinges entirely on management executing. executing on that huge supply chain realignment, hitting the 85% target this year, 95% next year for China supply from other Asian sites. And just as importantly, executing on that disciplined deleveraging plan, getting net debt below 3 times EBITDA by mid-2027 like they aim to.
So it's a bet on management hitting their operational and financial targets.
Pretty much. If they deliver on those promises, the whole narrative around the stock could genuinely shift over the next, say, 3 years. It could move away from just defense and margin protection towards that secular AI fabrication enabler story.
And if that happens, combined with a broader semi-market recovery, maybe in 2026?
There could be significant upside potential. The big risk, obviously, is execution risk. What if the recovery is slower? What if they stumble on the deleveraging? That's the flip side.
Got it. Long-term value based on execution.
Mm-hmm.
Any other ideas? Maybe something more tactical?
Well, again, not advice, but for a shorter-term perspective, maybe an event-driven play focused on those catalysts we just mentioned.
Okay, like the Analyst Day and Q3 earnings.
Exactly. You could potentially look at something like a call spread, maybe with November expiry to capture both events, possibly paired with a protective put spread just to manage downside risk.
Interesting. So what's the bet there?
The bet is basically that the market might be overly pessimistic right now, that the September Analyst Day could provide more positive detail on margins than expected, or that Q3 results might show better progress on tariff offsets and efficiency gains than currently priced in.
So playing for a positive surprise based on upcoming events?
Kind of. Looking at the options market, there seems to be a bit of a defensive skew right now, suggesting maybe an underestimation of potential good news from these catalysts. It's tactical, event-focused, higher risk, of course.
Two very different approaches there, highlighting the strategic crossroads the company's at. Okay, great ideas. So let's wrap this up. Entegris Q2, a mixed bag. Beat the headline numbers, but that year-over-year revenue dip, the margin pressures, the high leverage, those clearly weighed on investors. But they're making some pretty significant, bold strategic moves, localizing supply chains, managing costs, aiming for a stronger second half.
And positioning for that long-term growth in advanced materials, especially linked to AI.
Right. Now, just a reminder to everyone listening, this analysis is purely for informational purposes. It is absolutely not financial advice. Please always do your own research and due diligence. So thinking about all this, what really stands out to you about how a company like Entegris tries to balance these immediate short-term challenges, tariffs, costs, debt, while still pushing forward with a long-term strategic vision in such a fast-moving, expensive industry like semiconductors? It's a tough balancing act. We really encourage you to dig into the details, think about those trade-offs, and form your own conclusions. Thanks for tuning in to The Deep Dive.